Good afternoon. This is Steve Campbell, president of Cornerstone Wealth Advisor Group in Fishersville, Virginia. We tape a radio show on WSVA in Harrisonburg, 550 AM, 92.1 FM, every Saturday morning from 7 to 8 a.m. And we talk about financial news, talk about financial subjects. And today we taped a show talking about the difference between value investing and growth investing. One of our listeners called our office one day and said, I don't understand. My 401k is invested in the S&P Value Index, and my 5-year return is 11.99%. But then I looked at my wife's 401k plan. She's invested in the S&P 500 index, and her 5-year return is over 15%. And I don't understand why I'm trailing her 401k. So we did a radio show talking about the difference between value investing and growth investing. And by the way, the S&P 500 is a blend of growth and value. And it's very confusing, for investors to look at their account and see that they didn't make as much money. He thought the S&P was the S&P. And so we had a little discussion on the difference between value investing and growth investing. So let's start out with value investing. Women love value investing because they're value shoppers. Women, if they're shoppers, and I think that my wife has a PhD in shopping. She knows what a sale is. And so the idea of being a value shopper is you would never want to buy a summer dress in April and pay $140 for that dress if you could just wait until August for that same dress, maybe get it for $50 or $60 or $70, 30, 40, 50% off in price. And so they understand a value. Value stocks are cheaper, but the cause that they're cheaper is there could be a problem in that stock or in the sector that they represent. A sector in the stock market could be healthcare, could be technology, could be energy, could be consumer staples, things you have to have, food, toothpaste, underwear. Then there's another sector of the economy called consumer discretionary. Consumer discretionary is not necessarily buying things you need, but buying things you want. Maybe a big screen TV, maybe a four-wheeler, maybe a car, or a second car, or a Jeep. And so, for example, the best way I could explain the extremes of value investing, I think the biggest example would have been in 2020 during the early days of COVID. You would not want it to have been buying stocks of cruise lines as they were falling, because we didn't have any idea if cruise lines would ever come back, and if anybody ever went on a cruise again, how long it would be. And those cruise lines, the cruise line companies, were in serious enough trouble, their stocks were killed. Then, if you looked at 2020, what about airline stocks? Who was flying during the early days of COVID? No one. And there are people still not flying because they're afraid of being in a confined area with people that may or may not be healthy. And so airlines were really hurt. Gambling casinos shut down in the days of COVID. What about bricks and mortar retailers like JCPenney or Macy's, companies like that? Those stores were closed. And as a result, their stocks bottomed. Now, coming out of COVID, you hypothetically could have made a lot of money buying individual names, maybe buying them cheap and holding on to them. But what's been interesting in the last 5 years, value stocks have grossly underperformed the growth stocks. Now, what is a growth stock? It's a stock that is in demand. Their sales are booming. Their profits are booming. Maybe they're a technology company and they've come out with a new technology like artificial intelligence. And these companies, there's a great demand for the companies, and there's then a great demand for the stocks, which has driven up the price of these growth names. Now, what I didn't tell you about value investments is that, well, I guess I did. You buy a value stock, you hope to buy it at a discount to its real value. A growth stock is just the opposite because everybody wants it. The stock is doing well. If you're an investor, you have to pay a lot more for that stock. Now, today, for the radio show today, I went back and looked. I looked up Investopedia, and on Investopedia, I was looking for historical numbers on price to earnings ratio. The 90-year average price to earnings ratio in the stock market in the S&P 500 is about 16.07. That's historical. Currently, the S&P 500 carries a price to earnings ratio of almost 25, which, if that's the case, means that the stock market today could be a little overpriced. Now, what about value stocks? If they're unloved and unwanted and underappreciated, then their price to earnings ratio today is about 18 times earnings. All right, now what is the price to earnings ratio of the growth index, the S&P growth index? It's currently today at around 45. Now, if you had held growth stocks over the last 5 years, you've really outperformed the market and you've crushed value. But if you are currently sitting on a growth portfolio today, your stocks are historically way overpriced. So this listener who called in said, I have been trailing my wife's, the same S&P 500 fund, which was not the case. She owned the S&P, he owned the S&P value index. And his statement to me was, what should I do? And I said, well, first off, how old are you? He said, I'm 40 years old. And I said, well, whatever you do, you've got a long time to correct your investment portfolio. So I said, in the long term, you might want to think about right now just going from the value index maybe to the S&P 500 index, which is a combination of growth and value. I would not go from having underperformed for the last 5 years in value investments, jump over into a very high-priced area of the growth index. I would make that change in the S&P 500. And he said, well, that sounds like a good idea, which led me then to a real concern that I have. We all look at performance, and we look at performance and we want to be performing as well as we can. We want to make as much money as we can. One of the problems with this particular question that he had was sometimes it leads to the temptation of ditching something when it's really a good buy today. The fact that it underperformed the last 5 years could mean that it might overperform or outperform over the next 5 years, and we don't know the future. But it also would ask the question, if I've made 20% a year over the last 5 years or 18% a year over the last 5 years, and I own nothing but growth stocks, maybe I want to diversify. And that leads me to the last part of this is it would be good for investors to create with their financial advisor an investment policy statement. And an investment policy statement simply says, we're going to create rules for investing to live by. Now, I'll just give you a general example of that. Let's say that this 40-year-old who has 25 years before he is going to retire, he might say, until I am 5 years away from retirement, I'm going to be invested 100% of my money in stocks. I will own at least at all times 50% of my money in the S&P 500. I might own 10% in the small cap index, 10% in the mid cap index, and maybe 5% in gold and 25% in international stocks. Just use that as an example. What an investment policy statement hopefully does for investors, it prevents them from looking at their statement and maybe at a certain point, small cap stocks were up really big one year. And even though they've only had 10% of their money in small cap stocks, they might be tempted to go 100% in small cap stocks the next year, which I believe would be a huge mistake. Your investment policy statement is something that you want to incorporate in your investment portfolio to protect you from doing something that's based upon short-term performance. You want to have a long-term plan in your investment portfolio. Pension plans have investment policy statements. Large institutional money tend to have investment policy statements. And I think individuals should have an investment policy statement. If you have any questions, just Google what is an investment policy statement and why I should incorporate one in my portfolio. But clearly today, as we talk about the difference between value and growth, our radio listener who had called us said, I need help. We recommend that he may not, whatever he does, don't jump into the growth index, but maybe just own the S&P 500 index and beware that the next couple of years in the short term, that may not work out. He may have made more money if he stayed in the value index, but investing is a long-term proposition, and you want to be reasonable when you create your rules to live by, and then you want to stick with those rules. So, hope your day is good. Hope your summer is going well. And, hey, if you get a chance, tune us in on WSVA, 550 AM, 92.1 FM every Saturday morning. We start about 7:07 right after the news. We go to about 8 o'clock, and we'd love to have you listen, love to have for you to give us a call. We'd love to help you with creating an investment portfolio for you. You have a great day.
Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The opinions expressed in this material do not necessarily reflect the views of LPL Financial.